Hey everyone, welcome to the deep dive. Today, we're doing something a little bit different.
Different, good, different.
Yeah, exactly. We're ditching the complicated formulas and all the financial jargon that gives you a headache. And we're going to explore the psychology of money.
Love it.
Our guide for this deep dive is Morgan Housel's The Psychology of Money.
Great book.
It really is. He's a former Wall Street Journal columnist. And this book is packed with those like aha moments.
For sure.
Like you put it down, you're like, oh my gosh, why didn't I think of that?
Totally.
It's so true. So he shares this really interesting story about Harry Markowitz. Have you heard of him?
Yeah. The Nobel Prize winner.
Yes. He won a Nobel Prize for basically inventing a formula for like perfectly rational investing.
Yeah. Modern portfolio theory. It's a big deal.
It is a big deal. And you would think like, okay, this is the guy who's going to be following his own advice to a T, right?
Right. The perfect rational investor.
Yeah. But, well, not quite.
Not quite. What did he do? So his work, modern portfolio theory, really revolutionized investing. It's all about figuring out this precise mix of stocks and bonds to maximize returns and minimize risk. But guess what he actually did with his own money?
What did he do?
A simple 50-50 split.
Wait, are you serious? The guy who wrote the book on investing went with the equivalent of a coin flip.
It sounds crazy.
There's got to be a lesson in there.
Well, there absolutely is. See, Markowitz, he understood something absolutely crucial. The best financial strategy, it's not always about these complex calculations. It's about what you can actually stick with, especially when the market inevitably throws you a curveball.
Oh, yeah.
He chose peace of mind instead of trying to perfectly time the market.
That just makes so much sense. It's like when I tried that crazy restrictive diet a while back, you know the one I'm talking about?
Yeah.
Sure, it was technically like the optimal diet for weight loss, but I was so miserable. I was like counting every calorie. I finally caved and ordered like an extra large pizza.
We've all been there.
Sometimes the perfect plan just backfires because we're humans, not robots.
Exactly. And that's a key takeaway from Housel's book. The absolute best financial approach for you is something incredibly personal.
Right.
It's about finding what aligns with you, your psychology, your risk tolerance, your goals. If you can't stick with it, even the most rational plan on paper will just completely fall apart.
So you're saying it's better to be reasonable than to try to be like perfectly rational when it comes to money.
Absolutely. It's all about finding that sweet spot where your strategy is both sound and something you can actually maintain for the long haul.
Right. It's got to be sustainable.
Exactly. And that can be totally different for everyone.
Housel even talks about picking investments that you're actually interested in. Because if you're passionate about a company or its mission, you're less likely to freak out and sell when the stock price drops right.
Yeah, that emotional connection can be so powerful. If you really believe in what you're investing in, you're much more likely to ride out those inevitable market fluctuations.
Okay, so I'm starting to see the psychology at play here. It's not just about the numbers. It's about understanding your own motivations, how you react to risk, all of that.
Precisely. And honestly, this applies to broader financial strategies too. You're more likely to follow advice that resonates with your values, your own personal experiences, even your gut feeling sometimes.
Yeah.
It really increases your chances of long-term success because you're not constantly second-guessing yourself.
That makes sense. So we've been talking about finding a financial approach that works for you personally.
Finding that strategy that you can stick with.
Exactly. And that seems to be a big theme in the psychology of money.
Definitely.
Housel seems to be a big believer in consistency, right?
Yeah.
Like that's a big deal for him.
Absolutely. One of his core arguments is that when it comes to building wealth, it's not about finding that magic formula or timing the market perfectly.
Okay.
It's consistency that makes all the difference.
So like those get-rich-quick schemes you see online?
Exactly. They rarely pan out.
Not really a recipe for long-term success.
No, not at all. Housel found that the longer you can stick with a solid strategy, the higher your chances of success become.
Okay, so it's more like slow and steady wins the race.
Exactly. It's about harnessing the power of compound interest.
Which a lot of people describe as like the eighth wonder of the world or something like that.
It really is remarkable. Think of it like growing a giant oak tree.
Okay.
It takes time, patience, consistency, but eventually those small gains result in something incredible.
You get those massive results.
Exactly. Small, consistent gains compounded over years and decades. That's how you build real wealth.
Okay, that makes sense in theory, but it's hard, right?
Yeah.
Especially when you hear those stories about people like striking it rich overnight with some crazy
So
investment.
absolutely. I mean, those stories are everywhere.
And you're like, wait, Why didn't I think of that?
Right. But that's what Housel calls survival bias.
Okay, what's that?
Basically, we tend to focus on the winners, the people who made it big, and we totally forget about all the people who tried similar things and completely failed.
Because we don't hear about those people as much.
Exactly. They don't make the headlines.
Right, it's like that old saying, history is written by the victors.
Exactly. So we get this distorted view of risk and reward. We think, oh, that person got rich quick. Maybe I can too. But the reality is staying in the game, weathering those market ups and downs is often more important than any single win.
So resilience is key.
Absolutely. That resilience is what allows you to benefit from compounding over the long run.
So how do we cultivate that resilience?
Hmm.
Because let's be real, when you see your portfolio drop 10% in a day, it's hard not to panic, sell everything.
You're right. It's not easy. Our brains are wired to avoid losses.
Totally.
But Housel emphasizes this concept of margin of safety. It can really help.
Okay, a margin of safety. I like the sound of that.
Imagine you have a really important meeting.
Got it.
Do you leave at the absolute last minute, or do you factor in some extra time for traffic just in case?
Right, it's always got to factor in that extra time.
Exactly. That extra time, that's your margin of safety. It's about anticipating potential problems and giving yourself a buffer.
Okay, so it's about being prepared for the unexpected, not just hoping everything goes according to plan.
Precisely. And you can apply that same thinking to your finances.
How so?
Don't invest your entire life savings in one stock, no matter how promising it seems.
Diversification.
Exactly. And avoid taking on more debt than you can comfortably handle, even if interest rates are low.
That makes sense.
It's all about having that cushion, that margin of safety to help you navigate those inevitable bumps in the road.
So we're talking about thinking long-term, being consistent, and building in that margin of safety. That all sounds like solid advice, but do you have any examples of people or companies who actually apply these principles in the real world?
Absolutely. Housel talks about Sequoia Capital. Have you heard of them?
Yeah, they're like a big-time venture capital firm, right?
Huge. They've backed companies like Google, Airbnb, Stripe, you name it.
Wow, that's impressive.
And one of their core principles is focusing on the long-term viability of the companies they invest in.
Okay, so they're not just chasing the next big thing.
Nope. They're looking for companies that can stand the test of time. They prioritize survival and sustainable growth over those quick flips and short-term gains that a lot of other firms might go after.
You know, it's funny. We talk about making smart decisions with our money being rational,
Right, making those logical choices.
Exactly.
Yeah.
But sometimes you see people do things with money and you're like, what are you doing?
Yeah, we've all been there.
It's like they're making decisions that make absolutely zero sense.
It's true, and it can be hard to understand.
Right. And that's something that Housel really digs into in his book.
Definitely.
He says our financial behaviors, the decisions we make about money, they often come from a much deeper place than just like crunching numbers and looking at spreadsheets.
It's deeper than that.
Yeah, like what's an example of that?
He talks about how our past experiences, particularly those early years of adulthood, those can have a huge influence on how we view and handle money later in life.
Okay, so you're saying that stuff that happened years ago, maybe even decades ago, could still be affecting how we're investing our money today.
Exactly. Like imagine someone who grew up during a period of really high inflation.
Okay, yeah.
They've seen firsthand how quickly prices can rise, how their money can lose its value.
Right.
And that experience, it might make them more risk-averse later in life.
So they might be less likely to invest in stocks or more likely to hold on to cash, even if interest rates are super low.
Precisely, because their past experience has taught them that holding on to cash can be risky, but it can also be a way to preserve their capital when everything else is uncertain.
It's like they're saying once bitten, twice shy, right? But with money.
Exactly. Their past experiences shape their perception of risk, and that influences how they approach investing even decades later.
Wow, I never thought about it like that. So what you're saying is that what might seem like an illogical or even irrational financial decision to one person could make perfect sense to someone else based on their own upbringing and experiences.
Precisely. We all have these unique financial lenses that we're looking through, shaped by our own personal histories.
So like judging someone else's financial decisions without understanding their background is kind of pointless.
It's like judging a fish on its ability to climb a tree.
It's just not a fair comparison.
Yeah.
So how do we apply this understanding of financial psychology to our own lives? Like, how can we become more aware of our own biases and maybe make better decisions?
That's the million-dollar question, right? Housel talks about the difference between fast variables and slow variables. The economy, the markets, those are fast variables. They can change really quickly.
Right. Up one day, down the next.
Exactly. But our minds, well, they adapt much more slowly.
We're still trying to catch up to what happened last year.
Exactly. So even when a crisis has passed the emotional impact, those financial scars, they can linger for years and continue to influence our decisions even if we're not consciously aware of it.
So how do we identify those scars? Like, how can we tell if our past experiences are holding us back from making smart financial decisions today?
That's where some introspection can be really valuable. Take some time to think about your own financial history, your upbringing, your experiences with money, both positive and negative. What were the money conversations like in your household growing up? Did you experience financial hardship or witness it firsthand? Did you have any early successes or failures with money?
Those are really good questions. I'm starting to see how those early experiences could shape our beliefs about money, risk, and even our own ability to build wealth.
Absolutely. And once you start to uncover those underlying beliefs, you can start to challenge them. Ask yourself, are these beliefs still serving me well today? Or are they holding me back from reaching my full financial potential?
That's really powerful stuff. It's like we're not just making financial decisions. We're also trying to unlearn old patterns and break free from those limiting beliefs.
Exactly. It's a journey of self-discovery as much as it is about financial planning.
And it's a journey worth taking. Well, this has been an incredibly insightful deep dive into The Psychology of Money by Morgan Housel. It's clear that understanding the psychology behind our financial decisions is just as important as understanding the numbers themselves. So, as we wrap up, what are some key takeaways our listeners can start putting into practice today?
Absolutely. First, remember that reasonable often trumps rational. It's about finding an approach to money that aligns with your values, your risk tolerance, and your lifestyle so you can stick with it for the long haul.
Makes sense. What else?
Second, prioritize survival above those get-rich-quick schemes. Building wealth is a marathon, not a sprint. Focus on consistency, patience, and weathering those inevitable market storms.
Slow and steady wins the race.
Exactly. And finally, remember that everyone's financial logic is shaped by their unique experiences and beliefs. Be compassionate with yourself and others. We're all on our own financial journeys.
Great advice. Well, on that note, a huge thank you to all of you for joining us on this deep dive. We hope you found it as insightful and thought-provoking as we did. Until next time, keep exploring those fascinating connections between your mind and your money.